Welcome to the course on stock market. You must have heard people talking about stock market, stock prices going up, coming down, Sensex moving up, moving down, right? Making a lot of money, earning lakhs and lakhs of money in few days or few months. Well, so what is this all about? Yes. So we are going to talk about a stock market and how stock market functions in real time, and also how people make money in stock markets. So in this entire series of videos, we're going to talk about the meaning of share market, what is the actual meaning of share market, and what are the instruments that are traded in share market, the participants in share market, who all participate in share market, and what is that we talk about trend, so market trends. And we'll talk about income in share market. So what are the sources of income, like what all components we discuss when it comes to income in share market. And we'll be talking about investment and gambling. So most of the time, these two terms are used interchangeably, but these are not similar terms. There is a significant difference between gambling and investment. And also we'll be discussing the types of share markets, primary market and secondary market. So we'll be talking about that. And as part of primary market, we'll be talking about initial public offering and what is initial public offering process. And we'll throw light on Nifty and Sensex. So what is Sensex, sensitivity index, and also Nifty. And what is the procedure to invest in share market? So what is that you're supposed to do if you want to start your investments in equity market? And also we will understand the importance of share markets for a country, not just for India, for any country. So many things to understand. Let's begin our journey with the first concept. What is share market? Before we dive into discussions on share market, let us understand how a typical marketplace works. Let us think about a vegetable market. What happens in vegetable market in the morning? So people with commodity come to the market, and there are people who actually want to buy it, right? So there are buyers and sellers. So what buyers are trying to do, they're trying to understand what is the price at which I should buy. And at the same time, sellers are thinking like, what is the price that I can quote for my commodities? What is the price that is available? That is, what is the price I can get from the buyers? So the entire process of buying and selling intersects at the point that is called the price. That's called market price. So this market price is determined based on demand and supply factors. So same holds true when it comes to stock market or share market. We will understand what is the difference between share market and stock market. Most of the time, these two things are used interchangeably, but there is a significant difference between what is stock and share. So back to what is share market. A stock market is a platform where buyers and sellers come together to trade on publicly listed shares during specified hours of a day. So it's a platform similar to the common market where we talk about the vegetable market. Similar to that, here also the buyers and sellers come together to buy and sell shares. So here the commodity is replaced by shares. So shares are bought and sold, and buyers and sellers come to the marketplace to exchange this asset in the marketplace. So when they buy and sell, so based on demand and supply factor, the price of shares are determined. The stock market allows buyers and sellers to exchange the securities in the marketplace. This is a regulated and controlled environment in which the buyers and sellers exchange these assets. The people who want to buy, the people who want to sell this, and people who want to buy the stock are taking long position, and those who are actually selling this instrument are taking short position. And in the entire process, so what is actually happening? It is the price discovery is something that is happening here. So the buyers and sellers are agreeing to a particular price. That is something part of the price discovery. And this price discovery is happening based on the demand and supply factor. There are so many arguments that the price of a particular stock is determined by demand and supply factor. The intersection of demand and supply is the price. But there are certain arguments that says there is an inflation factor, the money supply and money demand. Those two things also have bearing on the stock prices. But that is still debatable item. But as of now, the price of a stock is the intersection of demand and supply. So far, what we see in the stock market is electronic system. So earlier was the days when the stocks were bought and sold on physical form, a physical share certificate. But now, thanks to technology, so we have no physical certificates where we have a digital electronic forms or electronic shares that are transferred. But only the ownership is transferred. The buyer and sellers will get to know that the ownership is transferred. But the physical form will not exist. Certificate will not exist in the physical format. And the purchase and sale of these financial instruments, especially these equity shares, will happen between 9 o'clock and 3 o'clock. So this is the trading hour. So if we talk about NSE and BSE, National Stock Exchange and Bombay Stock Exchange, the operations will begin by 9 o'clock and ends at 3 p.m. in the afternoon. So what are the instruments that are traded in share market? There are different instruments that are traded in the share market. Shares, bonds, mutual funds, and derivatives. So when we talk about share market and stock market, there is a difference. So what is share market? In share market, only equity shares are traded. But when it comes to the stock market, there are different other instruments that are traded in the market. For example, bonds, mutual funds, and derivatives. So stock market operates with all these instruments: shares, bonds, mutual funds, and derivatives. But share market operates only with shares. So what is share? Basically, a share is a share in the share capital of a company. Let's say the entire worth, the total capitalization of a company is 1 crore, and each share sold is worth of 100 rupees. So if I own one share of that particular company, that means I am a owner of that particular company for one share. So that's called share. Again, in share, there are various categories: equity shares, preference shares, redeemable shares, irredeemable shares. There are various categories in shares. Bond. Bond is a fixed income security. This is issued by corporates and governments, and the holder of bonds will receive a fixed rate of interest. This fixed rate of interest is largely a treasury rate or fixed interest. This is also called as a risk-free rate. So what is this risk-free rate? So generally, this risk-free rate is determined by the central bank of each country. This may be, in our case, in India, this is Reserve Bank of India who actually decides the treasury rate. This is also called as treasury rate or risk-free rate. And this rate is fixed by Reserve Bank of India. And this is something that is promised. And this is called risk-free because government will assure this interest rate is given to the holder. Those who actually wants to earn more interest, more money, will go to equity market, and those who wants to earn the risk-free rate will go to bond market. Bond markets are secure, safe, because these bonds are backed by the government of India. In case the corporate or the Reserve Bank of India is not able to repay this fixed obligation, the government of India will back it and they'll repay this money to the bondholder because the government of India has taxing power. That is bond. Mutual funds. So mutual fund is a basket of multiple securities wherein there will be multiple financial instruments that are added into this basket based on the investor's preference. And these mutual funds are managed by experts, the portfolio managers who understand how financial instruments can earn money in the market. They understand what is the return that can be expected from each financial instrument and what is the risk involved in each of these financial instruments. So this is mutual fund. So mutual fund may also have equity, fixed income security. They may also have other formats of financial instruments as well. Fourth one is derivative. So what is derivative? Derivative is a financial instrument for which the value of this will derive from an underlying asset. So here a derivative may be forward contracts, futures, options, or swaps. What is forward contract? Forward contract is one of the oldest derivative financial instrument that we can witness. Even now it is used. Basically, forward contract is an agreement between parties wherein parties agree to buy or sell a particular commodity, financial instrument, or an underlying asset on a specified future date for the price, quantity, design, and other specifications that are determined today. So the agreement will happen today, but the contract will be exercised on a specified future date. Here, forward contract largely happens over the counter. Over the counter means there will be no exchange involved to facilitate these transactions. Only the regulator is involved in these contract transactions, but most of the time these financial transactions will happen over the counter, and many a times these transactions will not even come to the radar of government or any regulators. That's forward contract. What is future contract? Futures contract is similar to forward contract in many aspects, but here futures contracts are transacted on regulated exchanges. Here parties agree to buy or sell an underlying asset on a specified future date for the price that is determined today. The transactions will be regulated by the stock exchanges or the recognized exchanges. You can see the difference between forward contract and futures contract. Here, forward contracts happen over the counter. Futures contracts are exercised on regulated exchanges. So this is futures contract. Options. The third category in derivative is option. What is option contract? Option contract is an agreement between parties wherein the option holder has the right but not the obligation to buy or sell an underlying asset on or before the maturity date. Here, the options again, we have call option, put option. Call option is option to buy, and put option is option to sell. Again, there are further categories in options: American options, European options. So American option and European option are similar in terms of the nature, but the only difference between American option and European option is American options can be exercised any day before the exercise date, but European options can be exercised only on the maturity date. So that's the difference between American option and European option. So these are the financial instruments that are part of derivative. So forwards, futures, options, and swaps. Now, what we need to remember here, share market and stock market. In share market, only equity instruments are traded. In stock market, there are multiple other financial instruments that are traded in stock market. It may be shares, bonds, mutual funds, or derivatives. Who are all participating in share market operations? There are multiple parties who are actually involved in share market operations. It may be investors, exchanges, speculators, arbitrators, brokers, regulators, advisors, or maybe depositories. So investors are the people who actually participate in trading activities. They have long-term invest in the company. They have long-term interest in investment world. So they stay there for 1 year, 2 years, 3 years, 5 years, sometimes even 5-10 years, and they make money and they exit the market. They are investors. They have long-term investment interest. Exchanges are regulated platforms where the transactions happen. It may be National Stock Exchange or Bombay Stock Exchange. So exchanges facilitate this transaction. Speculators are the individuals who invest in stock market for a very short time. Basically, the purpose of speculators is to make quick money and exit the markets. They come in, they buy and sell the shares in few days and few hours, and they'll exit the markets. So speculators will have short-term interest in the markets. Arbitrageurs, they buy and sell stock simultaneously in different markets, and the difference is what they actually gain in the market. So buying and selling an instrument at a time and find out the difference between prices of each this particular financial instrument in different markets, and they make money and they exit the market. So these arbitrageurs also have short-term interest in investment world. Brokers are the people. These brokers, the main function of brokers is to facilitate this transaction. So they bring people for trading activities. So the individuals approach brokers when they want to invest money. So brokers will buy and sell financial instruments on behalf of the investors or speculators. Regulators, here in stock market, regulator is Securities Exchange Board of India. So this is called as the watchdog of capital market. SEBI regulates and monitors the capital market functions. So they are the regulators and who actually come to understand if there is any concerns in operations in capital market. Advisors help investors and traders in taking investment decisions or trading decisions. They are the people who have skills and knowledge about stock market, and they are the people who can help individuals in buying and selling financial instruments. Depositories called NSDL, CSDL. NSDL is National Securities Depositories Limited and CSDL is Central Depositories Securities Limited. So these are depositories. So basically these depositories are institutions that are mainly focusing on conversion of shares into electronic form, storing them, transferring or giving delivery of those shares to those who actually buys them, and also they participate in settlement activities. Those who buy and sell, so when there is a difference in buy and sell, they settle the transactions between parties to the contract or to equity transactions. So they are depositories. Market trends. So market trends, you must have heard it's a bullish market or bearish market. So what is bullish and bearish in stock market? Well, so you can see the image on the screen. There is a bull and bear. So what do you see in bull? So bull is aggressive, right? So it's aggressive, it is in fighting mode, it is looking like it is attacking mode, right? So that's called it is bullish, right? So bullish signal, that means the market is moving up, market is going down, that means that's bearish. When the market is going down, we say the market is bearish. When the market is moving up, we say it is bullish. So these are the trends we generally see. And also there is a market called sideways market. So sideways market is nothing but the market is neither moving up nor moving down, right? So that's called sideways market. So bullish trend and bearish trend. So most of the time in market, we can see these two terms, these two trends. Either it is a bullish trend or it is bearish trend. For example, I will look at Sensex today, and the Sensex is 20,000 plus 20,300 or whatever, example. Tomorrow when I observe the Sensex is 21,000 or 21,000 and above, I say it is the market is bullish. That means the market is going up. That's why I'm calling it as bullish. If the market comes down from 20,000 to 18,000, I say the market is bearish. That means what it indicates, like bullish and bearish. In bullish market, there are more number of buyers who are actually buying the stock. Investors and traders keep buying stocks in the market. That is bullish trend. The market is moving up. When there are signals that the stock is not doing good or the stock is stagnant, individuals start selling it. That's called bearish trend. In the bearish market, investors and traders keep selling that particular stock in the market. So that's why it's called bearish. Bearish means they're scared in the market. In bullish means they're more aspirant. They're interested more in buying activities. That's called bullish. What are the income sources in market, in capital market? When we talk about the share market, so what all money individuals can earn? There are two categories of income that an individual can make in the share market. It is dividend or capital gain. What is dividend? Consider I'm investing in Infosys shares and I'm holding my investments in Infosys shares for 1 year. At the end of 1 year, Infosys will declare something called dividend. So this dividend is given to the shareholders, equity shareholders. This is based on the company's performance. Company has earned well in the last quarter. Let's say there are 4 quarters in a year, quarter 1, quarter 2, quarter 3, quarter 4, and an aggregate, Infosys has done well in all 4 quarters. Those who invested in equity shares of Infosys will get dividend. So that's called dividend income. Capital gain. Capital gain is something that when an individual invests in Infosys share and they want to sell those equity shares at the end of 1 year or 2 years or 3 years. So what is that they get is called capital gain. I invested 1 lakh in Infosys shares and I'm selling all the shares of Infosys after 2 years. Say I'm receiving 2 lakhs. I invested 1 lakh. I'm getting 2 lakhs. This 1 lakh is my capital gain. This is what I'm earning by investing in Infosys shares. Consider I'm not looking for 1 year, 2 years income. I'm considering only for weekly income or daily income. So I invested 1 lakh in Infosys shares and after 2 days, I can see 1 lakh is becoming 1,20,000 and now I want to exit the market. So what is that I'm going to get now? So I'm going to get that is something called trading profit. So this is the trading income. Many times investors do not want to stay with market for a long time. They want to enter, make money, exit. Profit is the only motive for them. They just want to make money, exit the market. So that's called intraday trading. I'm just trading and exiting the market when I make the profit. That's trading profit. Let us understand what is the difference between investment and gambling. Many times these two terms are used interchangeably. So investment and gambling. So many times it looks very similar because gambling also we invest money, we make profits. In investment also we make profit. And many times these two things looks very similar. There is a significant difference between investment and gambling. Gambling and investment they're not the same, right? So let us see some of the parameters in which we can differentiate what is investment and gambling. If you look at the time frame for investment and gambling, investments are made for long term. Gambling is for short term. So gambling will have a very short span of time to make money. But in investment, there is a long term perspective. Risk level. In investment world, the risk is comparatively low. In gambling, the risk is higher. The probability of winning the markets, winning the trades is very limited. The risk is higher. Expected returns in investment is usually positive. When we invest money in equity market, we expect 8%, 10%, 12%, 15% returns. This is a positive return. When we invest money in a fixed income securities like treasury bills, I expect 5% because 5% is something that markets promise me. The bonds will give me. That's a treasury rate. Right? When it comes to equity market, of course, I'm taking risk in equity market. I need higher returns. If I'm not able to earn more than 6%, then I'll not go for equity. I'll go for fixed income securities like T-bills. So in equity market, the returns are more than fixed income securities. Here, mostly these returns are positive in nature. There are rare occasions where investors will experience negative returns in case of market is not performing well, or rather the market is becoming negative, it's going down. Otherwise, the returns will be positive. When it comes to gambling, there are possibilities for negative income. I may lose my entire stake. I may lose my life savings. I may lose everything that I've invested. So that is not the case in equity market. Because in equity market, the liability of the holder of equity is restricted. That is to the face value of that particular share. So beyond that, there will be no risk for an individual who invests in equity market. Economic utility. So what is the economic utility? Here in investment, the economic utility is more because this is what is actually expected in investment. But in gambling, There is no economic utility here. It is a personal utility. The personal utility is something that is focused here. The stability of income in investment is expected, and this cannot be expected in gambling because there will be no surety, right? That the money will come or not. There will be no assurance. Nature. Here in investment, the investments are objective in nature. So when we make investments, we'll have some objective elements to investments. There will be some parameters based on which the investments are made. But in gambling, there will be no objectivity here. It will be subjectivity. It will be purely based on the personal opinion of the gambler. The returns will come. So there will be a subjectivity. There will be personal bias. There will be hard human emotions that will have impact on the decisions of gambling. The type of person in investment is a conservative person who actually concerned about the protection of funds. They're more concerned about the protection of fund. Then comes returns. In gambling, they're more aggressive. The gamblers will be aggressive. They'll be looking for higher profit, abnormal profits. But in investment, the investor is conservative. They expect practical returns in the market. For example, in investment, it is mutual fund investment. When it comes to gambling, it may be lottery or casino games. In investment world, there will be a collateral. The investment itself is a collateral, but in gambling, there will be no collaterals. That's why it is very risky. What is the base for investment? There will be a scientific approach before every investment, but in gambling, there will be impulsions, there will be predictions, or there will be guesswork. It's all about the probability of winning the game. So it's all about guesswork. But in investment, there will be a scientific approach. I'll try to understand the market based on the historical data, based on the economic factors. What are the types of share market? Share market can be seen in two categories, primary market and secondary market. So primary market is one type of market we can see, and the other part is secondary market. So what is primary market and secondary market? So primary market is largely, it is IPO, right? So when a company wants to raise funds in the market, they'll go to IPO market. In fact, it's a compulsion to go for IPO. For example, if a company wants to raise capital in the market, they cannot go directly with the exchanges and they cannot do trading. Rather, they're supposed to go to a primary market. They need to register their IPOs. They have to go through the process and they have to raise the funds. After that, they can enter the secondary market. So IPO market is always called as the primary market. So when you hear the term primary market, you remember IPO. So IPO is nothing but it is initial public offering. So basically, going to primary market is a matter of pride. It is a pride. It's a question of pride for companies. If a company is going to primary market, that means they feel pride because they're able to go to primary market to raise the funds, right? So when there is a need for capital, the companies will either borrow from their sources or they'll go to the primary market. In primary market, there are options to raise funds based on the requirement. And also by entering into IPO market, they can access capital from international sources, because international sources may be ADR, GDR, right? So American Depository Receipt, Global Depository Receipts. So that gives them an option to raise funds. By entering primary market, what companies are trying to do, they're trying to understand, they're trying to do the price discovery. So what is the price a company can fix for the shares? This is something can be done by entering into the primary market. And it is also a part of market testing. So by entering into primary market, the company is testing whether we are worth of raising funds, whether we worth of listing our capital, listing our company shares in the secondary market. So that is initial public offering. What is the process for listing in primary market? The process is straightforward and very simple. There is a 7-step process that every company need to follow when they want to raise funds in the primary market or when the company wants to list in the primary market. Step 1, hiring an investment banker or underwriter. 2, registration for IPO, verification by SEBI, making applications to stock exchanges, creating awareness through roadshows, pricing of IPO, and allotment of shares. So let's understand what is this each step is all about. Step 1, the company that wants to raise capital in the primary market, the first thing they're supposed to do is hiring investment bankers and underwriters. So investment banker in some countries is called as the merchant banker or underwriter. So investment bankers are experts in raising funds in the market and they understand the pulse of market. So what is the requirement in the market? How much of money can be raised in the market? And what is that investors are looking in the market? What kind of stocks will be accepted in the market? So they understand the pulse of the market. So that's why a company, first thing they do is they'll hire investment banker or merchant banker or an underwriter. So in this process, the company will supply the entire deal transaction, that what is the information available, right? So what is that money that need to be raised and what is that duration they need to take and how much of money is required for investments in long-term opportunities. So all this information should be given to the investment banker. And also, what is the instrument they are planning to issue is also something that they need to circulate. For example, it is a share or the bond or whatever. So that information need to go to investment banker. So when a company is choosing investment bankers, they look at a lot of things. They look at the reputation of that investment banker in the market or the quality of research that they do or the kind of expertise they carry. So all these things are the parameters to identify investment banker or underwriter. Because remember, the success or failure of an IPO largely dependent on investment bankers. The way they raise the funds, the way they portray companies' requirement is something that's very important. Based on that, investors will come to a company to invest money. Step 2, registration of IPO. So this is very important. So the first step is hiring investment banker. The next step is registration need to happen. So the registration need to happen, and here the company need to prepare a document, a registration form they need to fill, and they also need to submit something called RHP. It's called draft prospectus or red herring prospectus. So this is not an actual prospectus. This is a draft prospectus, and this is a mandate to submit this RHP, red herring prospect, to according to Companies Act 2013, and this is a SEBI regulation. So SEBI has mandated that a company that wants to raise funds in primary market, they need to go through this IPO process, and this process they need to register their IPO and they need to prepare a red herring prospectus. And here a red herring prospectus, the draft prospectus, will have the definitions of the company. So what are the things that are important in this business? What is the risk involved in this particular business? Why this money is required and how the money will be utilized by this IPO process, and what are the business details, what is the nature of the business, and who are the people who are actually managing this company, and what is the purpose of these managers and board of directors. And also it will have a legal information related to the business, right? And also the industry orientation, what is the industry in which the company is operating, and what is the viability of this particular business. And also it's very important to add audit reports into the red herring prospectus. In the third step, the Securities Exchange Board of India will do thorough screening of this proposal to list this particular stock, and this verification will go in terms of the material facts that are presented to SEBI. So SEBI verifies all this information, whether the information submitted is authentic in all aspects, and also they'll validate the documents that are attached for this listing, right? Suppose that they'll give the approval, and this is also called as cooling period. What is cooling period? So cooling period is nothing but in this period, if there is any corrections required for this application for the listing can be done. So SEBI will ask the company to do this verifications, corrections, modifications, or whatever is required. That's why it's called cooling period. So it is not that all the applications that are given to SEBI for listing will be accepted or all the applications that are given will be rejected. Sometimes SEBI will suggest some changes that are required in red herring prospectus. So those changes the company need to do, and they need to do the resubmission. Post that, the process will continue. Step 4, making an application to the stock exchanges. So once SEBI gives approval to go ahead, the next step is to approach the stock exchanges. The stock exchanges may be NSE or BSE. So right now, 7 to 8 stock exchanges that are actively operating. There were too many stock exchanges earlier, like approximately like 20 to 28 stock exchanges are discontinued their operations due to various reasons. So right now, 8 stock exchanges are operating, and out of that, 2 exchanges are actively trading the instruments. So that's NSE and BSE. So once the listing is done, basically the stock exchanges will give a marketplace to these financial instruments. So buying and selling of these active instruments will happen on these stock exchanges. And these stock exchanges, basically they bring the investors and companies together, and also they'll bring intermediaries into the marketplace. So here the participants are company, investors, and intermediaries. So intermediaries will help investors in making investments in these particular companies. So the overall, the stock exchanges helping the entire transaction to happen. So they list these companies, and the buyers and sellers directly buy and sell these stocks on the stock markets. And the stock exchanges have the responsibility of safeguarding the interest of millions of investors. That's very important, because regulation is very important, because there is lots of money involved in this share market activities. Step 5, creating awareness through roadshows. So once this approval is given by SEBI and the listing with exchanges is completed, the next thing is the promotion. Of course, promotion is important for any company, right? So even right now, this IPO process is known to stock exchanges and company, right? The public is not aware of this whole deal, right? They need to understand which is the company issuing stock and what is the price of that particular stock and what is the nature of that particular business, right? So the investors will get to know about this IPO process only when these investment bankers make these roadshows or advertisements, right? They do advertisements for a few weeks just to attract the potential investors who want to invest. And also they organize question and answer sessions. So there will be question and answer sessions and also group meetings. It may be virtual or in physical, right? And they also go for social media promotion. So in social medias also they promote these stocks, these listings, and they explain these kind of offerings are available in the market. Those who are interested can invest in this particular stock. So once this promotion is done, the potential investors will come to know which stock is actually getting listed on primary market. So that gives them an opportunity to buy stocks beforehand. When people buy stocks on secondary market, it is something that is available to them at later stages. Those who want to enter into this equity transactions at the earlier stage of the company, it's a golden opportunity for them. For example, I believe in this particular company and this company is going to do wonders, right? So this company is going to perform extremely well. Now the company is getting listed on stock market, and that means this is the right time to enter. This is the right time to participate in the growth of this particular company. So I like the way the company is performing. So I want to participate in the operations of this company. I want to be part of the success story. So I take IPO. So this can be done only at primary market, not in the secondary market. So investors can take shares in primary market, that is IPO market. Step 6. In this step, pricing of IPO will happen. So far, the formalities are completed. Now, the company will enter into the stage where they'll fix the price for the shares. So there are 2 ways to fix the price. It's book building process or fixed price. Book building process is basically, this is a process is open for say 10 days, and in 3 days they keep the books open and they give a range in which potential investors can choose a price band. For example, this particular stock is available between rupees 100 to 150. Those who wants to opt the shares can quote their own price in this particular range, rupees 100 to 150. Those who opt in this range, those who opt for highest price in this range will be given the shares at the end of this book building process. And those who have quoted very low in this range will not be given the share, rather they'll be given back their money along with the interest thereof. This is book building process. And again, the price of this particular instrument will be determined based on the demand and supply factors. So how many potential investors are interested in buying this particular stock and how many wants to buy at what price. Based on that, the price will be determined by the investment bankers. The second method that is available is fixed price. Here, there will be no scope for investors to choose the price, rather they're the people who are actually taking that price. So here the price is fixed by the investment banker in consultation with the company, and the company will propose a price and investment banker will validate the opinion of the company and they'll fix the price in agreement. So this is between company and the underwriter or investment banker. So these are the two methods that are available to fix the price in primary market. The last step is the allocation of shares. So once the price is fixed, the company is obligated to allocate shares for those who do highest bidding in book building process. Right? So within 10 days, the company need to allocate those shares to the bidders, the potential investors, and those who are not getting the stock, they'll get their money back along with the interest. And here, once the allocation of shares happens, these shares are now available in the secondary market and you can buy the shares and sell the shares on the listed stock exchange. So this is the entire process of how initial public offerings will happen in the primary market. Stock indices. You must have heard stock index, right? So multiple indexes, NSE, CNX, Nifty, Sensex, right? So Sensex is one of the most popular index in India, right? So there are so many indexes, right? So what is that index is all about? Basically, index is a bunch of securities, right? So it's a group of securities that are used to give a signal of a sector or a economy. So there will be a standard number of stocks. If you look at Sensex, so Sensex has 30 stocks. It's standard and that has been maintained for a long time. So 30 stocks will be there, and these stocks are the representatives of various industries. One from automobile industry, one from steel industry, right? So one from service industry, one from banking industry, like this. It's a combination of multiple industries where stocks will be representing each industry. So it will be 30, and these 30 stocks will keep changing. It will not remain the same, right? So it will keep changing and new stocks are added and old stocks are removed based on the weightage and the performance of that particular company in the industry. So each company will be given a weightage in index. So when we talk about CNX Nifty, Nifty 50. So what is Nifty 50? So Nifty 50 is it's an index of 50 stocks from various industries. And also you can see Dow Jones Industrial Average, DJIA. It is again the combination of 30 stocks representing 30 publicly listed companies in United States, right? So 30 publicly listed stocks in United States. Standard & Poor 500. So it's again self-explanatory, right? So 500 stocks makes this particular index. And Nasdaq Composite, right? So there are various indexes that are part of stock exchange. So stock exchanges will have these indexes, and these indexes are traded, right? So these are available in the market. So it is when it comes to derivatives, these are the underlying assets in underlying asset, and this is called as underlying asset in derivative market. Well, what is the procedure to invest in share market? So can I go and buy a particular stock directly? The answer is no. So there is a well established process to buy the shares of any company, right? So the first step is to open a account called demat account. Okay, so demat account, or this is also called as this is trading account. So when you have an account in your bank, right, so it is saving account or current account. But here, if you want to trade on financial instrument like equity, you need to have demat account. So these demat accounts can be opened with any intermediary. It is up to you, whoever the intermediary you want to go for. It may be ICICI Direct, HDFC Securities, or Sharekhan, Angel One, or Axis Bank, right? So it may be Zerodha as well. So based on your requirement, you can choose the intermediary and you have to open demat account with them. And the entire process of opening this demat account may take 2 to 3 days. In that period, you can open this account, and this is the operational time required to activate your account. And they'll do something called KYC. That means when you fill a registration form with any of these intermediaries, they'll do something called KYC. KYC is know your customers. So when you open an account with a bank, so they'll do KYC. KYC is mandatory according to Reserve Bank of India. Same holds true when you want to invest your money in a particular stock. You have to open demat account, and when you want to open demat account, you have to fill this form called KYC form for trading purpose. So your intermediary will have all your information, if not all necessary information about you, before they allow you to trade on particular financial instrument. And they would request you for the documents like PAN card, Aadhaar card, cancelled check, income proof, the recent photograph, or your address proof. So they would require all these documents to open demat account for you. So do not get confused. When you open demat account, it is not something that your bank account, right? If you have a bank account, that is required, and your bank account will be linked to demat account. And demat account is another account that you need to open. So you need demat account and also bank account. And you also need to give a cancelled check during your KYC formality. So that is step 1. Step 2, once your demat account is open, you need to choose the company in which you want to invest your money. There are 1,300 plus companies that are traded in Indian stock markets, right? So it is up to you which company you want to choose, which industry you want to choose. You want to choose company from banking sector or automobile sector, iron and steel, any sector, right? So you can choose company from any sectors. So you have to choose company. So when you're choosing company, there is something called liquidity. That's very important. For example, you want to trade, you don't want to invest. When you want to trade, what does that mean? You want to buy, sell securities and make profit, and you want to exit the market. So when you want to exit the market, there will be some liquidity, right? For example, there are, as I mentioned, 1,300 plus companies that are trading in the market. Not all the companies are actively trading, right? So some companies, stocks you can buy and sell, but some companies will have only buyers more and sellers less. When the sellers are more, buyers less, right, there will be liquidity, right? The sellers and the buyers need to be there in the market. Then only there will be liquidity for a stock. So you have to choose companies carefully because some companies are illiquid in nature, right? If you want to buy the stocks of that particular company, there will be no sellers. When there is no seller, you will not be able to get that particular stock. When there are too many sellers for a particular stock, the liquidity will be better, right? So there are so many sellers and there are less buyers, you will get the stock quickly, right? You can buy it easily. So based on the liquidity, you have to choose company. There is another factor called volatility. Remember, volatility in equity market is risky, is considered as risky. But when it comes to derivative market, volatility is the gift, right? The volatility will bring a lot of profit to the trader there. But in equity market, volatility is actually considered as a curse, right? So people do not want to buy in a stock that is highly volatile in nature because it may go down, go up. suddenly. So that would take a lot of your toll. For example, if you want to invest in that particular stock, you need to be very careful. You need to be ready to lose the money. So volatility. Long-term value, when the investments are made for long-term purposes, like I want to invest money for 10 years, 20 years. So you have to choose the company carefully, and the company that has consistent growth is the company that you are supposed to choose, because growth is something that you're looking for in your investments. The speculation value, when you want to make quick money in equity market, you have to go for speculative stocks. Speculative stocks means those stocks that are liquid in nature, right? So the buying and selling of those stocks will happen quickly in the market. So those are the stocks called speculative stocks. So that's step 2. Step 3, you have to choose the price point, the price at which you can buy that particular stock. Remember, there is a mantra in stock market: buy low, sell high. You can buy stock low and sell at high and make the profit. For example, I buy it at 50 rupees 50 and I want to sell it at 70. So buy low, sell high. When the stock is low, I will buy it. When the stock is high, I will sell it. The difference is my profit. So that's something that you need to remember in investing. The price is based on market research. Remember, when you invest in equity market, you have to do a lot of research. Like, what is the price in the market? Is this the intrinsic worth of this particular stock, or is the stock price has gone up just because there is some artificial or there is some fabricated impressions in the market that is actually pushing the stock prices up, right? Because always remember, markets are not driven just by supply and demand factors. There are investors called pseudo investors who actually enters the market only to alter the direction of the market, and they just exit after that. So it may happen. The investors need to be careful. The price of a particular stock is not inflated price, it is the intrinsic price, and that is the price that I can buy this particular stock at, right? And when we invest in a share, there are 4 different prices that we can see on trading platforms: open, high, low, and close. And also there is a adjusted close. So these are the prices that are generally seen. Most of the time, the closing prices, especially the adjusted closing prices, are the prices that are analyzed in investment decisions. And open, high, low, close will be for the day. What price the market will open in the morning, and what is the price that will reach throughout the day, and what is the price that records in a day, and what is the price at which the market is closing. Those are the prices that you can get to see in the market. Step 4, completion of the transaction, right? So once you are convinced about the stock, in which stock you are supposed to invest, and the price at which you want to buy a particular stock, you have to submit your order to your intermediary. If it is Zerodha or Angel, ICICI, Kotak, whoever the intermediary is, so you have to submit your order on electronic format, right? So if you have an app where you can submit your order, buy or sell order, or you can go to your intermediary who will exercise your right. They'll exercise your order on the trading platform, and after that you will take the delivery of shares if you are buying, and if you are selling the stocks, you will give the delivery of those shares. And this entire process will be facilitated by NSDL or CSDL. So National Securities Depositories Limited, and CSDL is Central Securities Depositories Limited. So what is the difference between these two depositories? NSDL is managed by NSE, National Stock Exchange, right? And CSDL is the other depository that is managed in the stock market. What is the importance of share markets for a country, right? So share markets are very much part of our life nowadays, and there is a lot of talk about investments in equity shares, stock market, and all those things. So how it is important for a country, right? So without which, what will happen to a country? So that is something that is to be discussed. Stock markets or share market is considered as the barometer of an economy, right? So today, if you look at United States, the growth of United States economy is also measured in terms of how its stock market is doing, right? So there's a lot of money that flows through capital market because there is 2 things. One, the saving and investment. How savings are happening in a country and how investments are happening in a country makes a lot of significance to the entire economy. So the savings that are generated, right? So the savings that are made by households will flow to the capital market. And how capital markets are utilizing these funds, how capital markets are transferring these savings to companies, and how companies are utilizing these funds makes a lot of sense to the economic development of that particular country. So that's why stock markets are considered as the barometers of economic conditions. Share market promotes savings and investments because those who are able to save will be able to invest, right? Those who are saving will show interest towards investments, right? And share markets help companies to understand the price at which they can raise funds, right? It's also called as price discovery. Safety of transactions. So stock markets ensure the money flown into the capital market is safe because the stock exchanges will facilitate these transactions and the regulators will have an eye on the money that is flowing through the capital market. Capital formation, as obvious, when the savings are flown into the capital market, there will be capital formation. Those who want to save, they'll become investors or traders. They'll do capital formation. Inflation hedge is one of the very important point that we need to understand. Shares are a very good inflation hedge. They're considered as very good inflation hedge. The capital markets, the share markets will give returns that is higher than the treasury rate or the inflation rate of that particular country, right? So as of now in India, we can see 8 to 9 or 10% of returns that we can expect in share market, even 12%, right? So that 12% is bigger than 5% that is treasury rate, right? So that's inflation hedge. So equity instruments hedge the inflation effects efficiently. Contribution to GDP. Share markets contribute to GDP in terms of mobilizing savings and transferring those savings to those who are in need, because in economy always there will be two classes of people, like those who have money, those who have excess money, and those who are looking for money, right? So those who are actually having money, they want to invest and they want to earn money, right? When they transfer that money to those who are actually looking for money, and the people who are actually utilizing this money will transfer the rewards in terms of interest or the profits. So that way it will contribute to the GDP of a country. Spreading equity culture. By investing in share market, the ownership culture will grow, right? So when you invest in a share of a particular company, you are the owner of that particular company for the proportion of shares that you hold in that particular company. So that will spread equity culture. And liquidity is very important. Share markets ensure liquidity because a frequent buying and selling of financial instruments like equities will provide liquidity to companies and also to the public and also to the people who actually invest in that particular stocks. And speculation. So it will help speculation, buying and selling and making profit. So that's called speculation. So that will give speculative benefit to the country. Like when the money is speculated, when the stocks are speculated, the buyers and sellers will be able to quickly transfer the ownership of financial instruments and they're able to realize the monetary aspects of that particular instrument. Transparency. The transactions in capital market are transparent because the regulator involved and also the parties involved in these transactions are controlled by stock exchanges, and also the stock exchanges are controlled by regulators and authorities. Flexibility of investment. This is very important because those who want to invest, for example, if I have 100 rupees in my hand and I want to invest in equity market, yes, there is a stock that is available to invest, right? So 100 rupees. If I have 1000, yes, there are stocks to invest. I have 1 lakh, yes, there are stocks. So there is no problem in terms of finding stocks in the market. The stocks are available in different prices, from lowest prices to highest prices. There are stocks called penny stocks. So these penny stocks are like very small value stocks like 20, 25, 30 rupees or 40 rupees, and we can buy these stocks in volume. So flexibility in investment. So we can buy how many number of investments we want, or we can buy any number of shares you want. That flexibility is available in share market. So that brings us to the end of this discussion on share market. So here is a quick recap of what we have discussed so far. A stock market is a platform where the buyers and sellers come together to trade on publicly listed shares during specific hours of the day. There is a difference between stock and shares. In share market, only share is traded. In stock market, mutual funds, bonds, and derivatives are also traded along with shares. Participants of stock exchanges may be investors, regulators, depositories, brokers, arbitrageurs, right? And also we talked about market trends. So bullish trend, bearish trend. When the market is going up, we call it bullish trend, and market is going down, we say it is bearish trend. Capital gain and dividend are the returns in stock market. So capital gains and dividends, and also the trading profit. Investment and gambling are two different things, not to be mixed up. So investment and gambling are very different from each other. Share market can be classified into two categories, the primary market and the secondary market. So the primary market is also called as IPO market. So initial public offering. A stock index is a group of shares indicate the market sentiments. That's all we have in this course. I hope you enjoyed. Thanks for watching.
If you haven't subscribed to our channel yet, I want to request you to hit the subscribe button and turn on the notification bell so that you don't miss out on any new update or video releases from Great Learning. If you enjoyed this video, show us some love and like this video. Knowledge increases by sharing, so make sure you share this video with your friends and colleagues. Make sure to comment on the video for any query or suggestions, and I will respond to your comments.